Hello, everyone. Topic 2, title is the Conceptual Framework for Financial Reporting. This topic, we're going to look at some of the elements, the conceptual framework for financial reporting, and the objective of this topic is so that the students are able to understand and also explain some of these concepts. So we're going to look at three things. Firstly is the accounting concepts and principles, the main ones. And then we're going to look at who are the users of financial statements. And finally, we're going to go through some of the qualitative characteristics of accounting information. Now, we start with the basic accounting concepts and principles. Right? If you go through any accounting textbooks, okay, they will begin with these concepts and principles. Okay? So for this module, it lays down these 10 concepts and principles, starting with the money measurement concept, okay, whereby it states that the financial information, okay, is stated in monetary terms, and the company has to choose which currency it is denominated in. And of course, it depends on the, first of all, the country, as well as the capital markets with which the company, if it is listed, okay, so what particular currency the market as well as the country uses. Right. Secondly, is a separate entity of a business or a corporation, which mainly translates into a business or a corporation is a separate legal entity, separated from the owners, also the management that runs the company. So in a case or in an event that the company is being sued, for example, okay, for certain corporate misconducts, right? Or even certain cases that involve the system procedures. When it goes to the court, it is the company or the corporation that is being sued as a separate legal entity, okay? Unless the employee or the management themselves are personally liable and they themselves individually being sued. So that's a different matter. But if the company is being sued, then it is a separate legal entity. Okay? This is to draw a line, okay? And also to differentiate, sort of to come up with or develop a veil. We want to construct a veil that separates the corporation as a legal entity and also the owners, management, or employees of that particular corporation. Okay, next, we have this concept of going concern, okay, whereby the assumption that a business, okay, is will continue to operate, to be in business, okay, for infinity, okay, for an indefinitely long period of time, okay, into the future, right? Unless, okay, if let's say the business faces financial distress and is prone to bankruptcy, okay, then it's a different matter. We have to value it differently. Okay, so this assumption will not hold then and there. Okay, whenever the company faces financial distress or possibility of bankruptcy. Okay. Next would be the historical cost concept, okay, which states that or requires that all assets to be recorded, okay, at cost, okay, when they were acquired, okay, at the beginning when they were acquired, which is at cost, right? Similarly for other items as well. Okay, but the development of IFRS, okay, which is also followed by the Malaysian Accounting Standards Board, okay, in our MFRS, there is this introduction of a fair value measurement, okay, and standard that applies to certain assets or certain items depending on the nature, condition, location, etc. Right, but the basic concept would be historical, unless it is stated otherwise. Okay, the fifth one would be the accounting period, okay, where the time frame would be a year. So we call it an accounting period or fiscal year. Normally it ends on 31st December, okay, but there are other financial year ends as well, okay, including end of June, even September. Last time we even have financial statements ends in March. Okay? But over time, okay, many companies have changed to be consistent with others, which is 31st of December. And there are cases whereby certain companies change their financial year, okay, halfway through, okay, halfway middle of the year, they change the financial year end, okay, for some reason. Number 6 would be the conservatism concept, okay, where more times than not, right, any valuation or estimation of financial items must be based on conservative method, okay? Meaning it is preferable for the company to understate, okay, its say net income or net assets rather than overstating them, okay? Particularly if you face certain uncertainties, if the nature of the business or the nature of those items can be uncertain. Okay? So the concept, the idea of prudence, okay, hold here, okay, which leads, of course, to the for the companies to be conservative. Right. Number 7 would be the accrual concept. Okay, this is an important concept in accounting, whereby revenue is recognized. Okay? It's only recognized at the point of sale, right? And expense is recognized when it is incurred. So, say you sell on credit, right? Even if you have not collected or received the cash yet, but you already recognize the revenue, you already record the revenue, okay, as being recorded. So that is accrual concept. Similarly for expense as well, when it is incurred, even if you have not paid for the expense. Concept whereby the revenue have to be matched with the expenses, vice versa. Right? So you can't record an expense, okay, for a revenue not yet generated. Okay? So let's say the expense for this year has to be matched with the revenue recorded, okay, or generated this year. For many companies, it's not that there shouldn't be any problem. It's not problematic for many companies, but for certain companies, okay, with certain business models, okay, it may be quite tricky. It can be complicated. Okay? For example, we take a property developer, for example, okay, whereby the first of all, the development of the project may take years, and it will not be until, say, the second or the third year, right, that you actually sell the houses, okay, for example, whereas the expenses, okay, most bulk of the expenses you have already incurred at the early stage of the project, okay, whereby um, the revenue comes in later. Okay? So for certain companies, of certain businesses, it's quite tricky in terms of matching the revenue and expenses. But of course, with certain methodology and certain assumptions, okay, this is where the accountants come in. So they will help out the company in developing the financial statement, in this case, the income statement. Right, number 9 would be the consistency concept, okay, which states that once the company has chosen um, an accounting method, okay, say for example, in depreciation, right, you have chosen the simplified straight line method, or for the inventory, you have chosen the last in, first out method, for example. So you have to stick with the methods, right? And don't change it, okay, come the next financial year. So you have to be consistent, right? Next would be the final one would be the materiality concept. Okay? So it needs to be material. Material means it is relevant and related. Okay? Related to the as far as the context of the financial report for that particular company is concerned, right? It is related and relevant, and it is significant. Okay? It is not trivial, right? This can be quite can be tricky, a little bit tricky, or quite tricky, depending again on the businesses. And this is where the accountant use their expert judgment and as well as common sense, right? So they need to understand the business, right? Some businesses can be quite complex, right? When it involves, for example, financial instruments such as derivatives. Right now we have the fintech, okay, the development of fintech, so it can be quite complicated. But at the end of the day, it is the common sense and also the expert judgment of the accountant come into play, right? Okay, so those are the basic or the main accounting concepts and principles. Later on, we look at some of the examples on how these concepts and principles are applied and being reported, okay, or described in the annual report of a company. The users, okay, there are various users, of course, but the 5 listed here are considered as the main, okay, main users of financial statements. Okay. Number 1 would be the management, of course, to play their role as the management in managing the company, okay, on planning, directing, controlling, right? They need to make good decisions, okay, and informed judgments. Okay. One of the basis or one of the references, okay, for the management would be the financial statements, right? Especially when they are planning on expansion, for example, to chart growth, growth of the company. So they really need to understand, okay, the financial statements in and out, right? Secondly, it would be the investors, okay, even current or prospective investors, and also the shareholders. Okay? As I've mentioned in the first lecture, okay, shareholders or investors are the owners, okay, of the company. So they need to keep track. They are very much interested in the financial statements of the company, okay, as a benchmark, right, of financial performance, of the company, as well as a way into looking at the future, okay, the future returns for their investment. Number 3 would be the creditors and suppliers. Okay. Of course, the creditors from time to time assess the financial strength of a company, and they will look at the financial statements. Okay. Financial statements, especially banks, um, they rely and really assess, scrutinize the financial statements, okay, for company. Number four would be the employees, right? So if let's say they plan to stay long, okay, if they decide, if they have a plan to stay long in the company, they would very much interested to look at the long-term prospects of the company, okay, meaning the financial sustainability of the company. And one of the ways is by assessing the financial statements. And finally, we have the regulatory bodies, right? This is for compliance and regulations. Okay, we have the Company Commission, Securities Commission, Bursa, okay, even central bank for that matter, okay, that are interested in the financial statements and all the information contained, okay, in those statements, to look at whether there are any irregularities, okay, fraudulent cases, okay, and whatnot. Okay, next we go to the qualitative characteristics of accounting information. Okay. First, we look at the fundamental qualitative characteristics. Okay. There are basically two main characteristics. Okay. Now, when we look at the word qualitative, okay, as opposed to quantitative, of course, quantitative are numerical, quantified. Okay, so it is pretty much straightforward and objective, right? It's black and white, right? But for qualitative, to a certain extent, in some cases, are quite subjective, right? And it requires sometimes a few other layers or steps, okay, before we can actually determine, okay, whether or not the financial statements um, are prepared according to the standards, whether or not the items really represent what they should be telling, right? So the two main characteristics, the fundamental qualitative characteristics are firstly relevance, okay? And secondly is faithful representation. Okay? Relevance, okay, this is quite redundant to earlier point just now, the materiality concept, okay, whereby the item, okay, the information that is being reported, okay, is relevant and has value, okay, and it also, if let's say you don't report it, okay, then um, it will make a difference, okay, in terms of, or it will affect, okay, some other decisions, financial decisions. And this value can take on confirmatory value, which is the exact, okay, value and straightforward, all right, or predictive value, okay, whereby this is the element of subjectivity comes in, where you need to come up with an estimate or a prediction. Okay, so again, we come back to the property developer as an example, right? If you want to report the revenue and match it against the expenses, right? So there are certain criteria that you need to apply, okay, in order to ensure that whatever revenue that you report to be generated for that particular year are really relevant, okay, for that particular year. The rest you would put it for next year, okay, or for those that has been for last year, you don't record it, or it is not relevant for that particular or the current year. Okay. Now, the faithful representation, okay, this is where the managers, especially the financial managers, right, play an important role, okay, whenever they report or record or present whatever information, okay, to the accountant and later on to the auditors, right? So it must be complete. Okay, you don't miss out, you don't hide, okay, or you don't overstate, right? And it has to be neutral. Okay, you don't put in your own biased judgment, okay, in order to overstate or understate certain values. Okay, so it has to be neutral as it is, and of course, it has to be free from error. Free from error here means as much as possible, you try to provide accurate figures or accurate numbers. Sometimes you need to exercise what you call the best estimate. Okay, the best estimate. Again, for certain companies that involve in financial complex financial instruments such as derivatives or fintech, right? So sometimes you need to come up with estimates, right? For certain straightforward conventional business such as manufacturing, okay, it may not be that complex or difficult. Okay? So there are guidelines, okay, on how to present this in a faithful manner, how to represent the figures in a faithful manner. Okay, so you have to ask what is the economic phenomenon. You have to understand it, and you have to try to explain it in the most straightforward way as possible. Okay? And what is the relevant information surrounding that particular phenomenon? Okay? And is the information available? And can it provide a faithful representation of that particular phenomenon? Okay? So those are the guidelines, right? Now, in order to enhance the qualitative characteristics of these statements, okay, so you need to have these four uh, items, okay, or characteristics. Okay, first is comparability. Okay, so it must be comparable, and in order to be comparable, okay, one important criteria would be consistency. Right, it has to be consistent. Okay, goes back to the say the methods that you choose. For example, the way how you calculate the revenue, the way how you lay out the project. Let's say it's a 5-year project in total. So how do you divide it into say 3 financial years, okay, to encompass the 5-year project, okay, for example, and whatever method that you use for one financial year has to be consistent. You can't change it come the next financial year. Okay? And secondly, verifiability. It must be verifiable. Okay, it must be verifiable. You can verify it. Okay, and this is where you sometimes you have a model, okay, and whatever variables or inputs that you have in the model, say the revenue model, okay, um, it needs to be verifiable. Okay, you need to have some sort of a checklist, right? So it can be verified. You don't have a surprise, or you don't have some sort of a hidden crystal ball, okay, for you to calculate the revenue. It has to be transparent, okay, and it has to be consistent. Okay, right. The next one would be timeliness. Okay, so the information is available at all times. Okay, so whenever the accountants, okay, and later on the auditors come in and request for the information on that the variables or inputs for those items in the financial report. So it has to be available, okay, and ready. Okay, and right. Next one would be understandability. Okay, so the information has to be clear, okay, and it has to be concise, right? Even though okay, in certain cases, as I mentioned just now, the examples that I've given, there could be some complexity or uncertainty. Okay, you try as much as possible to simplify them, okay, to disentangle them into understandable pieces, okay, so that any reasonable, okay, and knowledgeable users of financial reports can understand them, right? So you have to be able to do that. Make the information understandable, right? So in short, those are the uh, some of the right conceptual framework, okay, for financial reporting. Okay. I have here some of the examples. These are taken from the annual report in the notes to the accounts section at the back, right? And so let's just look at roughly take a look at some of these notes. Okay. Now this is in explaining the basis of consolidation. Okay, the consolidated financial statements are uh, consolidated items. Okay, they consolidate the financial statements of various subsidiaries. Okay, this company is 7-Eleven, right? So it has many subsidiaries. So when combining the or aggregating the figures, right, you must have a basis. Okay, you must have a method, okay, that you follow, okay, in order to come up with this consolidated statement. So the business combinations, okay, these are the method used using acquisition method, and the notes explains, okay, how this is done, right? And this is with respect to which particular MFRS. Okay, so if let's say some of the assets are financial assets or financial instruments, then it is under the MFRS number 9, for example. Okay, so it is stated in the notes of the account. Okay, now for the asset sides, the property, plant, and equipment, okay, it says that it is recorded at cost, so using historical cost concept, right? And it further explains on, it also includes the carrying amount. Okay, some of the assets may be, uh, you know, uh, in progress. Okay, work in progress, right? And as well as any other related, okay, items such as maintenance, repairments, and whatnot. Right? Okay, so just run through to show you an example, okay, of how the accounting concepts, right, are applied and also explained in the annual report. Okay, this is for the depreciation for the assets. So these are the types of assets that the company has. It has buildings, land, computer equipment, motor vehicle, furniture, right? So these are the useful lives. Okay, they are using straight line basis, and these are the useful lives. So each asset has a different useful lives. Okay, this is for investment property. Okay, so they define what is the investment property and how they measure and recognize the loss, the gain or loss, okay, out of the investment. Okay. And these are for financial assets, right? The definition and also the description of how they are classified, valued, right? And the gain or loss incurred, right? These are for inventories, okay? And cash equivalents. These are in the um, current assets, okay? The non-fixed asset section in the balance sheet or statement of financial positions, okay? Right. This is the fair value, okay, measurement, okay, how they apply the fair value measurement concept, okay, for their non-financial assets. Okay, this is how revenue are recorded. Okay, so what you see in the balance sheet or statement of financial positions, sorry, what you see in the income statement, right, in the P&L, are the final revenue figure. But the notes explain how the revenue is derived or calculated. So in this case, for 7-Eleven, okay, it is not just sale of goods. Okay, it also um, includes the provision, okay, of in-store services income. Okay, some stores do provide certain services, such as photo stating and whatnot. And then you have rental income, interest income, franchise dividend, rebates and incentives income as well. Okay, so at least 7 sources of revenue, okay, for 7-Eleven, and they spell out on what are the basis of the revenue calculation, okay, from each of these source, right? And okay, this is again, okay, estimation of the um, certain risk. Okay, this is recognition of incentive and rebates, and also revaluation of property, plant, and equipment. This is with regards to the something that occur in the assets but affect the income statement. Okay, the P&L of the company. And this is with regards to revaluation, okay, of their fixed assets. Okay. I think that's all for this topic. Okay. So next would be topic 3 in a moment. For topic 3, we're going to look at the preparation and interpretation of financial statements. Right. Okay, we're going to look at the first of all the objectives of financial statements, and then the structure and content of financial statements, and finally, what are the other components and disclosures made in published accounts. Right. The annual report of any company would comprise of all these statements. Start off with the statement of financial position. The famous name for it is the balance sheet. Then we have the statement of comprehensive income, which is the income statement or profit or loss statement. We have the statement of cash flows. This is the accounting cash flow statements. In finance, we have another statement which is called the financial cash flow statement, which is slightly different from the accounting cash flow statement. And finally, a statement of changes in equity. Now, the objectives of each of these financial statements, it serves slightly different, but at times redundant objectives, okay, or functions. Right? For financial statement of financial position or balance sheet, okay, mainly to look at the value of assets, liabilities, and equity in the company. So this is more like a snapshot. Snapshot means at that particular point of time, how much are the assets, liabilities, and equity of that company. And the figure that you see in the balance sheet um, is a culmination of all the changes that have taken place from the beginning, since the inception of the company, okay, at birth or since the beginning. So it's a snapshot. Whereas for the statement of comprehensive income, this is like a video recording, meaning over one financial year, how has the company performed in terms of revenue, how much expenses have they occurred, how much interest have they paid, okay, how much tax have they paid, how much dividends are they paying to the shareholder. So over that 1 year period. So this is like a video recording from the beginning, 1st January of that year up until 31st December. Okay? So it is different from the balance sheet earlier. So the objective would be different. The statement of cash flows would look at the evolution or the progress of the cash related items. Okay? So it combines both the balance sheet as well as the income statement to come up with the cash. So at the end of the day, you are able to come up with the net cash position as at the end of the year, okay? From the beginning. So it's also a 1 year record, okay? Recording of 1 year of the cash flows, activities that involve cash for that particular company. Changes in equity also looks for that particular year, although the items that are coming from the balance sheets, okay, are a snapshot, but the activity that transpire for that particular year are embedded into the statement so that you can look at or you can keep track on the changes, okay, on the equity, okay, which reflects the shareholders' equity. Now let's look at the structure and content of each of these statements. We start with the statement of financial position, but before that, right, we need to understand the difference between company and group first, right? As well as before we look at the statements, okay? Because in the annual report, as you will see or you have seen before, okay, there are two columns. One is group, the other one would be the company. Okay, the group represents the consolidated statements, okay, for the company and also the subsidiaries under that particular company. Whereas the right column for the company reflects or refers to the holding, the parent company. Okay? Say, for example, the 7-Eleven Malaysia Holdings Berhad is the parent or the holding. This is the company that is listed, right? And it has stakes in these subsidiaries, in these companies. So, for example, it has 100% ownership or stake in 7-Eleven Malaysia Berhad, of course, Convenience Shopping, Sabah Sembilan Berhad, SEM Intra, 7 Properties, okay, and Teluk Juara. Whereas it has 46.5% in Digo, 60% in Cafe de Coral, okay, 60% in QVI Foods, and 75% in Caring Pharmacy. And Caring Pharmacy has its own subsidiaries, right? Which is quite a number, but I just show a snapshot here. Okay? So when you consolidate, okay, when you come up with a consolidated financial statement, you need to take into account the ownership percentage. Okay, you only recognize, okay, or factor in according to the ownership percentage, respectively. Okay? So when we look at the balance sheet here, for example, okay, you have this group, okay, for both years. The group here shows the consolidated, meaning you take into account, okay, the subsidiaries as well. Okay? And this column here, you see note. The note here shows that the explanation, the details of each of the item, okay, are explained in the note. Okay, so the note is placed at the back of the annual report after the director's. These financial statements are contained in director's report of an annual report. Okay? So it starts off with some director's report, auditor's report, and then the financial statements, followed by the notes to the accounts. Okay? So in this balance sheet or statement of financial position, this is a typical or conventional, but in some other companies, you may see a different presentation of the balance sheet. Okay? Over here, it starts off with the assets starting from the fixed, okay, which is the non-current. Non-current assets are also called fixed assets, okay, or long-term assets. Okay, these are the common examples of the types of non-current assets the company have. Property, plant and equipment or PPE, okay, right of use assets, because 7E okay, function as a franchise. They have intangible. Okay, we're going to explain later on what is tangible assets. Okay, other investment. Okay, trade and other receivables. Okay, these are receivables. Okay, and when you sell on credit. Okay, deferred tax assets. Okay, then you have the current assets. Okay, or non-fixed assets. Start off with inventories, okay, trade and other receivables, other investments, cash and bank balances. Okay. Now, we have two items here, trade and other receivables, okay, which are contained in both non-current and also current. Okay. The difference would be some of them it depends on their age. Okay. If they are more than 1 year, okay, so they are put here under the non-current assets. If it is within 1 year, it can be collected within, or it is within a year. Okay, it is considered as current assets. Okay, and notice that the items here are arranged in a manner, okay, starting from the least liquid, okay, until the most liquid, right? In some balance sheet, you start off with the most liquid. You start off with the cash and bank balances, followed by receivables, then finally only inventory. But over here, it's the other way around. You start off with the inventory as the least liquid current assets, okay, and ends with the most liquid, which is cash and bank balances. Now, the total of both non-current and current assets are the total assets. So for 2020, it's 2.036 billion, right? And the previous year was 1.422 billion. Okay, so there is quite a significant increase, mainly in intangible assets here. Okay, so we are going to analyze this later in the next topic, okay, when we do financial analysis. But for now, we're just going to go through and look at the items. And then we have the equity and liabilities. Okay. It starts off with the equity and then only followed by the liabilities. Okay. In many other balance sheets, they start off with the liabilities followed by equity, right? So the share capital reflects the paid up capital of the company, the number of shares. The treasury shares reflect revaluation if there are any increase or decrease in the share price with respect to the paid up capital, right? Then we have capital reorganization deficit. If the company has gone through a capital reorganization, and in this case there is a deficit, sometimes they have surplus, right? And then asset revaluation reserve, if they revalue the asset, and this is the accumulated retained profits. So whatever profits that you retain, if there is any balance after you pay the dividend, okay, so the retained earnings in the income statement every year would be transferred to the balance sheet here. Okay, so normally we call it accumulated retained earnings, okay, or retained profits. And the non-controlling interest here reflects the subsidiary. Okay, when the company has a minority interest in the subsidiaries. So this is a total equity, 161 million in 2020. All right. Next session would be the liabilities. You start off with the long-term liabilities or non-current liabilities. Okay, we have provisions, borrowings. In borrowings, there is an increase, 331 million in 2020. So the company made new borrowing in 2020 because the previous year it was only 25 million. Okay, and then lease liabilities, leasing, because they have many branches, many outlets, and many of them they lease, they do leasing, okay, instead of purchasing or owning the stores. Their contract liabilities and deferred tax liabilities. So the total um, non-current liabilities are 972 million. And then we have the current liabilities. Okay. The most important items here are borrowings. This reflects the short-term borrowings companies made. Okay. And we have lease liabilities. This is a short-term. These liabilities are trade payables, okay, because they engage with many suppliers, right, for their merchandise and products in the 7-Eleven stores. Okay. Other payables, okay, contract liabilities, and they owe taxation tax either to the government, So the total current liabilities come up with 902. When you add with 972, it gives you a total liabilities of 1.875 billion. You add this with the equity here, 161, that gives you 2.036 billion. That should be equal to the total assets earlier. So this is an important accounting identity, which is the total assets must always equal to total liabilities plus um, uh, equity. Okay, so the total assets, we call it the left-hand side, liabilities and equity are what we call the right-hand side of a balance sheet. Okay. Next, we go to the income statement. Okay. The annual report, we call it statements of comprehensive income. Okay. So this is where we divide it into two, group and company. Company refers to the parent or the holding company. Group is the consolidated, okay, figure which takes into account all the subsidiaries under the holding company. Okay. So the revenue recorded for 2020 was 2.539 billion. And note number 4 would explain, okay, or detail out the calculation of this revenue. Where does it come from? Okay, from which sources? Okay. Then they have cost of sales. Normally, cost of sales they do not disclose. Okay, they do not disclose because for many companies this would be a trade secret. Okay, something confidential, right? But of course, if you are an investment analyst, right, through certain fieldwork, interviews, going through certain documents and look at the practice, common practice of the industry, you would be able to break down the cost of sales for certain company. At best, the estimate. It may not be accurate, but a good estimate. Right? And then this revenue minus the cost of sales is what we call the gross profit. Okay, and 721 here indicates the sort of the viability of the business. Okay, so if okay, I just take the figure here, right? If we look at 721,887, the gross profit, we simply divide by the revenue of 2539, 028, gives us 0.284, okay, which shows us that the gross profit margin 7-Eleven is 28.4 This shows that for every 1 ringgit they generate for revenue, 28.4 cents is their gross profit. So the cost of their sale is about 72, about 72%. Okay, so for every 1 ringgit, the cost of sales is 72 cents. Okay, so this is the first stage, the first platform. If you want to look at the income statement and you ask yourself as a business, is this viable? Okay, is 28% gross profit margin is sufficient? Okay. Can my business be sustained for a long period of time with this kind of gross profit margin? And how do I fare compared to my competitors? Okay. So different business, different industry has different margin. For F&B, okay, we are talking about at least 50%. If you don't have gross profit margin of 50%, then you should not be in business, okay, in general. Okay, for certain business like say retailing, okay, sometimes it's less than 20. Okay, sometimes it's around 12 to 15 or even less, okay, depending on the type of businesses. Okay, so after that only come the other expenses. Okay, so the bulk of expenses are selling and distribution expenses, as well as the administrative. These are all the wages, salaries, utilities, right, and whatnot. Okay, marketing expenses. So for 7-Eleven, their selling and distribution expenses are huge. Okay, about 616 million. All right. So this is about, if I'm not mistaken, 1/4, almost 1/4 of their revenue. It goes to the selling and distribution expenses. Okay, and then we have the profit. These are the operating profit from operations. Okay, and you deduct the finance costs, interest you pay for borrowings. Okay, and come up with the profit before tax. Okay, and the tax. Okay, finally you have the profit after tax. The most famous name would be the net profit. Okay, and we have this segment here, okay, to show the other income. Okay, other income resulting from, okay, non-business activities. So in this case, revaluation of land and buildings, as well as taxation. This is not income, this is gain or loss due to tax loss, right? And you separate it out, okay, before finally you integrate them and you have this total comprehensive income for the financial year. Okay? So for 2020, for 7-Eleven, it is 35.59 million, okay? A decline from 54.9 million in the previous year. Then the profit, you break it down into how much is it attributable to the equity holders and how much to the non-controlling interest. This is the minority interest subsidiaries of 7-Eleven, right? Okay, and then the earnings. Okay, now for analysis purposes, we normally focus on the net income here at this stage. Okay, if you want to calculate certain ratios which involve net income. Okay, but in this case for 7-Eleven, the net income recorded here and the income after you break down into the minority interest, you deduct the minority interest of the company, is not far off. Okay, does not differ that much. 35.59 9598 versus 35.353. Certain companies, the difference can be quite significant. Okay, but in this case, it's okay. You just use the net income at this level or at this stage. The earnings per share is the net income divided by the number of shares outstanding, okay, for the company in that particular year, and it is in cent. 2.6 here refers to 2.6 cent per share, right? Later on in the next topic, I will explain to you the difference between basic earnings per share versus diluted earnings per share. Okay, let's be quick here. Okay, this is the statements of cash flow. And this is, as I've mentioned, the accounting statement of cash flow, which divide the statement into cash flows from operating activities. And these are the items that fall into the operating activities. And whether or not there is an inflow or outflow. If there is an inflow, positive. If it is outflow, negative. And then you net them out. Okay, so for this first section, it is a net 224 million cash from operating activities. Then you look at the investing activities. Okay? Basically look at the assets. Okay? The assets section of the company, the movement, any purchase or sale of disposal of assets. And then you look at the financing activities, okay? Starting from dividends, some of the equity items that fall under the equity or shareholder equity section, liabilities, loans, borrowings, and whatnot. Again, you look at the inflow and outflow and you record them. Okay? So you have these three subtotal here. Okay? Cash from operating activities, cash from or used in investing activities, and cash from financing activities. And you total them up, and the net would be 38.566 million here. And you add that with the balance carry from the previous year, which is 96.207 million. So the total for the end of the year would be 134,773 here. Okay? So the total that you see here, the net final figure in the statement of cash flow here, should be equal to the figure in the balance sheet earlier. Okay. Get the balance sheet, right? If you look at the cash item here, okay, 134,980. Okay. Here, 134,980. Okay, after taking into account the FD here. Okay. All right, so that is statement of cash flow, the accounting statement of cash flow. And then finally, the statements of changes in the equity basically looks at the movement or changes in the equity section, right? Whether or not there are, first of all, any changes, okay? Any acquisition, in this case, acquisition of treasury shares, right? And whatever income, okay, you recognize as retained earnings or retained profits, you record them here. And if the company pay dividend during that year, okay, you record them and you net them out. Okay, this is for 2020, and the statement also show for the previous year as well. Okay. Now, what about the other components? Okay, the other items in an annual report. As I've mentioned, before the financial statements are presented, we have the what we call the director's report as well as the auditor's report. Okay, we don't have time to go through them, okay, but I have enclosed the 7-Eleven's annual report, okay, in the LMS. Okay, so for the director's report, you can refer to page 74 in the annual report, and for the auditor's report, you can look at page 69. Okay, and the notes to the financial statements explaining all the items in the financial statements start from page 99. Okay, so probably if we have time during class later, okay, we go through some of these items. Okay, so that's all for topic 3. Thank you for your time.